The US economy is either in a recession now or about to enter a recession. And this has led many people out there to call for an everything crash, that the stock market's going to crash, that crypto is going to crash, and most importantly for this channel, that housing is going to crash. We're going to take a look into the data in this video. What I'm seeing is that inventory across the country is still relatively low. Inventory is very tight. And one of the biggest indicators for a housing market crash is increased inventory across the country. Now, there are pockets in the United States that have drastically more homes on the market today than before the pandemic. But that's not the entire housing market as a whole. The entire US has less inventory today than before the pandemic. Now, at the same time, home buyer demand is decreasing. There aren't many home buyers out there. So the questions you have to ask yourself as we gear up for the Federal Reserve's rate cuts here at the end of September is what is going to cause inventory to increase and in turn cause a housing market crash, or what would cause home buyer demand to continue to decrease. Now, yes, we could see more joblessness, we could see more unemployment, which would not be good for home buyer demand. But if rates are lower, people who have jobs will be able to afford properties out there on the market. So we're going to take a look at what has happened to the housing market in previous recessions. How have home prices been impacted during those recessions? And what can we expect as we enter into a recession today? Before we get into it, my name is Liam O'Reilly. I'm a realtor with Jerry Riley Real Estate. If you have any real estate needs, all of my contact information is in the description. Feel free to reach out to me directly. I would be happy to help you. So the first chart that we are going to look at comes out of the Federal Reserve Bank of St. Louis. This is the median sales price for all homes in the United States. And the gray lines here are recession. So we see here the 2008 recession, which is fresh in everyone's mind. We saw home prices drop from their peak in 2007 here at $257,000 down to their bottom, at least according to this chart, in 2009 of $208,000. Now, so other people say that the bottom was in 2012, at least according to this chart. Home prices started to rebound by then. So a pretty significant crash of about 20% in 2007 from that recession. But when we take a look back at the dot-com bust, we see here that in 2001, the median sales price was at $169,800. And then when we take a look at the end of the recession at Q1 2022, we see home prices were at $188,000. Even if we dip back to Q4 of 2001, we see that home prices were at $171,000. So not much of a change in the median sales price just based off of that recession. Now we take a look at the 1990 recession. We see here that home prices dipped slightly heading into the recession, which is similar to what we're seeing now. We see a small dip in the median sales price with the current market that we're in now. And then we see home prices remain flat throughout that recession. Same thing with the 1980s. We see a small dip heading into the 1980s recession, and then we see home prices remain relatively flat. They dip down slightly here from Q4 of 1981 to Q1 of 1982, and then remain relatively flat, trending upwards. And it's the same thing back in the 70s as well. So a recession alone is not an indicator that home prices are going to crash. A much better indicator for home prices is housing inventory and month supply. And when we take a look at housing inventory across the United States, what we're taking a look at here, this is the max chart. I'm going to zoom in to the 10-year chart. We see here that current inventory as of June 2024, 1.32 million homes on the market across the United States. Now, when we take a look at where things were back in 2019, in June of 2019, there were 1.92 million homes on the market in the United States. So we're still below, on a national level, we're still below where inventory was in 2019. And when we compare this to the 2008 recession, we see that in 2005, there were almost 4 million homes on the market. So there was a huge increase in supply leading up to the 2008 housing market crash that we saw. And that's ultimately what drove home prices down, was this massive increase of supply. There were way more homes on the market than there were people out there who wanted to purchase properties. We're not in the same scenario now. We have low inventory. There's not a drastic oversupply in inventory in most markets. Now, when we take a look at market specific data, we see that some metros are at a higher risk of home price declines. We see here, I've referenced this chart many times in my recent videos. I think it's really insightful to see what markets are most at risk for a home price crash. In my opinion, inventory, drastic increased supply of inventory, which is what we saw across the country in 2008, is the biggest indicator for home prices crashing. And we see here that these blue areas are markets where active inventory exceeds 2019 levels. So we see here down in Florida, it's back in 2019, inventory was at, there were 2,800 homes on the market in Lakewood, Winter Haven, Florida. Now there's about 4,200. So an increase of 53%. We see here in Austin, Texas, there's an increase of 41%. So these markets that are indicated by this chart, and I'll leave a link for this chart in the description so you can take a look at it for yourself. Those are the markets that are most at risk for a housing crash in the United States. Now, when we take a look at what's going on with Redfin, we see here that the month supply of inventory on the market, meaning the ratio between home buyers and home sellers, sits at 3.6 months supply in September, as of September 1st. Now, typically, if we're going to see home prices come down, that month supply needs to be above 6 months. Between 4 and 6 months is typically considered a balanced market where neither home buyers or home sellers have the advantage. It's relatively stable. Home prices tend to remain relatively flat. When month supply is below 4 months, that's when we see the median sales price start to tick up, which we have seen, at least according to Redfin. The median sales price is up 3.9% year over year. And once it goes over 6%, that's when we tend to see the median sales price come down. Now, when we take a look at buyer demand, if we just think this through logically, buyer demand is very low all the way down at the bottom here. According to Redfin, it's the lowest that we've seen in the past 3 years. We're above where we were in 2020, right before the pandemic, but we're below any period over the past 3 years. So there's less home buyers in the market as a result of these high prices and high interest rates. So when you think through the situation logically from a national housing market perspective, again, there's no national housing market, but when we take a look at everything in the US as a whole, we see that inventory is below where it was in 2019. So overall, we don't have an excess supply of inventory. At the same time, home buyer demand is well below what we've seen over the past few years. So that's why inventory across the country is increasing. When we go back to this chart, we see that inventory is trending upwards. When we take a look at the 10-year chart, we see this drastic increase in inventory back to around 2022 levels. So inventory is on the rise as home buyers are fearful, or as home buyers can't afford to purchase properties with these high interest rates and high prices. But the question you should be asking yourself is, will the Fed rate cuts, will mortgage rates decreasing bring more demand or less demand into the US housing market? I think it's going to bring more demand. As mortgage rates decrease, as the Federal Reserve cuts rates to help stimulate the economy and try to save the overall US economy, it will bring more buyers into the US housing market because things will be more affordable. That's at least what I see. Now, that doesn't mean that we can't see price crashes in these markets in Texas and Florida, or any market where there's an excess of inventory, specifically higher than 2019 levels. I think that's a great gauge to go off of. If you have more inventory, or 50% more inventory than we had back in 2019, and home buyer demand is lower than what we saw in 2019, then that's a recipe for home prices declining in those areas. But nationally speaking, for the entire United States, we are not likely to see an overall crash in home prices just because the economy enters a recession. So leave me a comment. Let me know what you think of this video. Do you think I'm right? Do you think I'm wrong? I love reading your comments. I do my best to reply to you. Thank you so much for watching this video, and I'll see you in the next one.